So we've got the latest research on ETFs and why they may not be particularly good for your portfolio. Let's set the stage first. Talk about what ETFs are versus your traditional mutual funds. So in a lot of ways, there's some similarities, right? ETFs are basically a basket of stocks, bonds, things like that. And so too are mutual funds. So they represent very diversified baskets in terms of ultimately what you own as an investor. But they also are a little different, right? So mutual fund holdings typically can change. In a mutual fund, you can own a company that is not publicly traded versus an ETF where all of the holdings have to be publicly traded. So there's no ownership of a private company or anything like that inside of an ETF. And ultimately, the underlying holdings don't necessarily change a whole lot. So recent research really concludes, this is courtesy of Morningstar, one of the appeals of ETFs, sort of what they were really designed for right from the very beginning, is in fact one of the things that undermines, or at least undermines, investors' experience with ETFs. See, ETFs were designed as a product that could ultimately be traded on a regular basis throughout the course of the day. And it's this notion of something that can get traded on a regular basis throughout the course of the day that ultimately, because of the very nature of how it is constructed, encourages people to trade and to move and to shift in and out. And unfortunately, ETFs have grown in popularity. The financial advisory industry in particular has really embraced these products. Over the past 15 years, more and more of the investing public's assets are going into these ETFs. There's now over $11 trillion with over 9,000 different ETFs out there. But it clearly is a product or an investment that is designed to be traded. And ultimately, that really does serve to undermine investor experience or investor results over time with these products. And so we're just going to read the straight out of the most recent study, and then talk a little bit about what those conclusions ultimately mean. So this is a study out of Morningstar, well-respected entity, and we're just going to read a couple of sentences about kind of how it all played out. So a new Morningstar report. And this is from an article in Barron's Magazine. A new Morningstar report titled Mind the Gap 2024, so obviously very current, analyzes the gap in performance between standard mutual fund returns versus dollar-rated returns, measuring how, so standard returns, meaning, okay, those just straight-up returns, versus dollar-weighted returns, which measure how investors who traded the funds, as opposed to simply buying and holding them, actually perform. So you've got, if you just own the thing and don't touch it, versus the actual investor performance owning the product. While there was a small gap for index mutual funds over the study's 10-year period of time, about 0.2 percentage points per year over that 10-year period of time, that wasn't true of index ETFs, where the average dollar invested earned 1.1% less per year than the fund's regular return. In addition, a 0.9%, so almost 1% per year return gap between mutual funds and ETFs. Now, that may not seem like a lot, but it's actually more than investors pay for many actively managed stock funds, negating one of the chief advantages of indexing. Folks, we've been saying this for years, all along. The more research that comes out on these products, look, these products are relatively new. Actively managed mutual funds have been around for 100 years. We talked about that earlier this summer on one of the programs where we recognize that the oldest fund in America turned 100 in July of this year. ETFs only around for maybe 15, 20 years. The data on them is just beginning to start to get compiled. Why? Because you need 10 years. You need 10 years of data before you can start to come to any conclusions on these things. this is a pretty significant underperformance as it relates to investor experience with these types of products. Now, the question becomes, why? So the folks at Morningstar, in particular this article from Barron's, speculated that there was, in fact, 3 different sort of reasons why you're seeing that underperformance when it comes to ETFs. First of all, ETFs are very popular outside of retirement plans. So if you think about mutual funds being very popular in employer-provided plans, things like 401ks, things like that, then ultimately when you're in that 401k or when you're on those 401k platforms, you kind of get like a Denny's menu of here are the funds that you have available to you. Pick one of them or pick a bunch of them, and that's that. And so what happens is then when people leave their employer plan and sort of go out into the universe, roll that account over, then you've got a universe of choices. And ETFs, becoming more and more popular, are just one. But the reality is that sometimes that universe of choices isn't really all it is cracked up to be. So the popularity of ETFs outside of retirement plans is sort of one piece of the puzzle. The second piece of the puzzle that the folks at Morningstar were pointing out is the types of indexes that ETFs usually track. So generally an ETF is going to be tracking a more narrower, specialized, often sector-based return. And here there's a whole nother conclusion of this exact same study by Morningstar entitled Mind the Gap 2024, where it determined that the more specialized funds wound up being even more volatile. And since they're ultimately designed to be traded regularly, I mean, that's the appeal, if you will, of ETFs. So you can trade them throughout the course of the day. Isn't that great? The problem is if you're trading more often, what tons of studies conclude is it's not really helping your investment performance. In this particular case, the more specialized those ETFs became, the greater that gap. So the gap in ETFs, over 3% per year over a 10-year period of time loss versus funds, which were somewhere like 1.9. Bottom line is the more specialized or the more sector-oriented you're getting, whether you're using funds or whether you're using ETFs, it leads to poorer investor behavior because you're always kind of a day late, dollar short, getting into something after it's already gone up, getting out of something after it has gone down. The third reason that Morningstar had sort of the speculation for why this misperformance for the investor experience when it comes to ETFs relative to the performance that they should ultimately be getting is the end clientele. I mean, if you look at kind of how and why ETFs were designed, the end clientele for ETFs is not the investing public. It's not the investing customer. It is, in fact, the financial services industry. It is the financial advisor, and because those products were designed specifically to be traded, to justify some of the high fees that we hear and see out there on a regular basis in the financial services industry. If I'm going to charge you 1.25%, 1.25%, or maybe 1.5%, or who knows what I'm charging, if I'm charging that, then somehow I got to come up with a product that allows me to justify that. Well, okay, great, fine. Maybe you're justifying the fee, but if at the end of the day, you're not actually delivering on the performance, doesn't that just kind of undercut the whole argument? I mean, as professionals in the industry, if you're a professional in the industry, in the financial industry, one thing should be kind of relatively apparent is like trading too much isn't good. It doesn't produce good results, right? Warren Buffett talks about trading at the pace of a sloth as being the right trading level that you should be at. But ultimately, industries were, working hard to make it look like they're doing something that, in fact, reduces your return. Prospects, in fact, had this conversation and asked me the question of, what's the most important thing? Folks, the most important thing is performance. Okay, one of the biggest things that impacts your performance from an investing result is how much you're paying for it. It's that simple. We're going to have some more thoughts on this, but first we're going to take a break. So stay with us through this one. It's an important concept based on the most recent study and research that come out of the folks at Morningstar, looking at the investor underperformance using ETFs. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning.